discussion. We're going to sort of try and sort of maybe split the discussion into two halves. Talk a little bit about the gold price and gold bullion and physical gold and all that sort of thing. And then we'll talk about the mining equities, the gold companies. And so I think I should probably start. Let's start with Sunil. You're looking very much at physical gold and who's buying what, inflows and outflows. What's happening in that space?
Okay. I'll probably focus more on Asia, just to give you, because I have first-hand experience in terms of Asia. So in Asia, the demand for jewelry this year, as most people have documented, GFMS has also, is pretty flat. I think the headwinds we've seen in China this year in terms of the general credit clampdown has had an impact in terms of retail spending. And the overall feedback we get from customers is jewelry demand has slowed compared to previous years. And they expect that that'll continue for some months to go because of the uncertainty on trade wars. And I know we'll talk about that later on. The second big market in Asia, of course, is India. India has been also going through some difficult times. Recently, the depreciation in the currency has meant that local gold prices have gone up as much as 10 to 15% over the last 3 months. And that's spooked buyers. In fact, this month is normally a seasonal high for demand because of Diwali. And the feedback we're getting from most of the retailers, jewelry retailers, is very pessimistic. They're saying that the actual local gold price is running at a discount to the international price because there's just oversupply. So the feedback in terms of China and India has not been very positive. However, if you look at some of the Southeast Asian countries, Thailand, Malaysia, Singapore, Hong Kong, demand is still okay. I wouldn't say it's fantastic, but it's still positive over last year. So that's as far as the consumption is concerned. There is one other aspect, which is besides jewelry demand, that's investment demand. Investment demand actually is quite okay, largely on the back of the uncertainty of the currencies. The emerging market currencies have been going through a lot of volatility. So a lot of investors are looking at gold as a safe haven. And so we've seen some purchasing of physical gold bullion for that. We've also seen and heard about central banks in the region accumulating reserves, gold reserves.
It's interesting, you sort of said two sort of slightly contrasting things there, that due to the uncertainty people aren't buying jewelry, but also due to the uncertainty people are
due to the higher price people aren't buying jewelry. So
Sure.
the jewelry demand really depends upon the actual price points. So if the price suddenly goes up, the jewelry demand slows off. But at the same time, when the investors start seeing gold price going up in local terms, they start coming in and buying. So there is that contrast in buying behavior.
I would like to add a small thing is the gold demand from China. I mean, the investment gold demand from China has not been that well this year. But I think it's about to change because a perfect storm is setting up right now. Think about it. The Chinese stock market has tanked this year so far, like by close to 50% or something from its like high levels like 1 or 2 years ago. And then the Chinese government used to impose more restrictions on the property market. Like they start relaxing those restrictions during last weekend, but like before, it is very difficult for people to purchase a property in China. So obviously there's no other reliable investment alternative for a normal Chinese citizen. Gold is probably one of the best ideas for asset reallocation. And every Chinese is now expecting the economic outlook of the country will getting worse next year. And many people are expecting the yen, the renminbi, is going to depreciate against the dollar further next year. So under these circumstances, gold is a very viable option for the Chinese. And there's one very important issue I have to raise. why the Chinese investment gold demand has not been that great in the past year or so, because we have to look at the Chinese gold price, not the US gold price. And last year, the international gold price did all right, but because of the appreciation of the yuan against the dollar, the Chinese gold price barely moved. And then this year, as the international gold price fell a lot, but the Chinese, because of the yuan depreciate a lot, so the Chinese gold price fall less than the international gold price. So in terms of volatility, the Chinese gold price has not been that attractive to investors. But I think this is going to change.
Interesting times. Dan, what's your take on this? You tell us a little bit about your company as well. Your trading, bullion trading.
Sure. So my background's a little bit different. I started my career right before the GFC. Actually, my first job offer was at Lehman Brothers Securitization at the headquarters in New York City. So in the eye of the hurricane, I took the job with the bank next door, Morgan Stanley, and saw everything happen. It was an extremely humbling experience. And well, before I go into this, actually, if it's okay with you, I'd like to ask the audience a question. How many people in this room think that gold is going to go to, let's say, $500 the next couple of years? Okay. How many people think that gold may go to $3,000 over the next couple of years? Any takers? One taker? Okay. 2005. Well, I only ask because I remember almost as clear as yesterday. I was a junior analyst at Morgan Stanley. There was a big investment conference, almost 1,000 people. We went, it was at the headquarters. We were at the very top of the Morgan Stanley building. So many important people were there, politicians, billionaires. And some guy on my team asked, how many people in this room think gold is going to go to 1,000? Literally not one person rose their hand. Not one. And that was very humbling to me, to teach me a very important lesson, which is that nobody knows. So I feel like gold is a very emotional investment. Most of the reason why people buy it, I think, is based on sentiment. The industrial uses, I think, they're there, but they're pretty small. And I think gold is a great investment to have, but I would also like to play the devil's advocate and say there are other precious metals as well that people can buy that are just as low in supply, just as they meet the same metrics for being a currency. So being a currency, you need to have a store of value. It needs to be a unit of measure, and it needs to be a medium of exchange. Now, you can't use gold bars to go buy your groceries. So I think that third one is, on the fence of whether you can use it. So, but the other two, it does meet that criteria. And there are other metals that also meet this criteria. So I'm bullish precious metals in general, but I don't own any gold. And if I do own gold, maybe I would be using, even though I understand all the limits of futures and ETFs, and there are a lot of issues with them, and I'm aware of them, I'd probably be using those instead because I think there's better upside than the other precious metals.
Absolutely. And given this, we're in this sort of trade war situation. One of the questions that's been asked is does Donald Trump want the US to have the strongest currency in a trade war?
Well, technically, the Federal Reserve is supposed to be independent. So, again, nobody knows the answer. But I really think that the story on gold is a story on the US dollar, in my opinion. And because the US dollar is the antithesis of gold, right? US dollar is the largest foreign exchange, at the fiat currency in the world, besides the euro, the yen, and the British pound. So that means you have to look at the US economy. And if you look at the US economy, we've had the longest stock bull market run. Right now, I think we're going almost 8 or 9 years now. So it really depends on your view of the US dollar. And usually the US dollar moves a lot based on what the central bank is going to do. So if you think the central bank is going to keep raising rates, the dollar may go higher and gold may go lower. And vice versa for the opposite. If we're going to go into a recession and the central bank cuts rates, the US dollar may go lower and gold may go higher. So I'm trying to keep it sort of simple in my view. And at this point, I'd probably maybe tend towards the latter. Go ahead.
Well, I think you're right generally in terms of what we've seen in the last few years is that sort of negative correlation. But it's interesting, at least for the last 6 weeks, we've seen the dollar strengthening, but we haven't seen gold weakening. We've seen gold strengthen. So I think some of the stuff that you read about and you talk about, which is this issue of safe haven for gold, is now kicking in. You've seen the currencies getting weaker, the Aussie, Canadian, etc., and gold still keeps going up $5-10 every week towards now it's 12.30. So we may be seeing a tipping point and a change in the momentum.
Yeah, exactly. I would also add, it's a game of confidence, and so far the dollar has been kept up by the illusion that it's worth anything. Everyone knows it's a paper currency that's based on hot air, like all the other paper currencies. And I don't think that Donald Trump particularly wants a strong dollar. He's actually made comments about the dollar being too strong. But in a trade war, there's only losers anyway. So the dollar might strengthen against everyone else for a while, but eventually it will catch up, and someone else devalues their currency against the dollar again. So it's a race to the bottom with all the paper currencies, and eventually I think there will be a point where the world realizes what the dollar is all about, and if you print a currency ad infinitum, then eventually its value will, like Voltaire said already, will go towards its intrinsic value of zero. But before that happens, I don't see the dollar disappearing, because when a critical mass of investors and people around the world realize what's really going on with the dollar, that the US is just printing it and getting a free ride and going on a shopping spree around the world based on a currency that they randomly print out of control, there will be a critical mass and this tipping point will come. And this will probably be the point where there has to be a revaluation of the gold price, similar to what happened in 1971 when the US temporarily suspended the gold convertibility and reneged on the Bretton Woods contract. And since then, gold has been allegedly in a free market. There will have to be a reset again to re-inject some credibility in the Western currency system. And mathematically, this means that gold will have to be revalued to something like $15,000 in today's terms. So it sounds totally crazy, but something like this will have to happen. And probably it happens over a weekend again, where Donald Trump or whoever is in the White House then will announce that from Monday we'll buy and sell gold at $15,000. And at that point, the US gold reserves, which are still at over 8,000 tons, some of the largest in the world, will be valued enough to support the even inflated amount of dollars in circulation to support the dollar as a credible currency again. Now you can say, of course, the 8,000 tons of gold, some people say it's not there. This is, of course, the million-dollar question. I have a slightly different view on this. Of course, the gold market is heavily manipulated, but I have no doubt that the 8,100 tons of official US central bank gold is still there in Fort Knox and West Point. The question is really who owns it, because the Fed and then through the bullion banks, they have leased it and then rehypothecated and sold it into the market 100 times over. So probably for every gold bar in Fort Knox, there's 100 people who believe they own it. And this is really the problem.
Sure? Okay. I'm going to just play devil's advocate with you, Thomas, and just respectfully disagree with you on just a couple of points. Mind you, I own precious metals. I'm be more than happy if the price of gold went to 20,000. I'd be super happy. But I think that we're in a very different environment from the 70s, mainly because of the debt situation. So I just read Ray Dalio. Ray Dalio is a famous billionaire hedge fund manager. He wrote a book called his thesis on the debt crisis and how they form. And right now, the amount of debt in the global macroeconomy is somewhere in the range of 300 trillion. I think it's a little bit higher if you include all the pension liabilities. So that's about 4 times higher than world GDP. And this has never happened before in economic history, ever, even during the Great Depression. So we are in uncharted territory, and debt is by nature, it's usually deflationary. It's not inflationary. So the 70s were a very, very inflationary period, and gold did exceptionally well, so did oil, so did a lot of commodities. But in a very deflationary environment, to be honest with you, I don't know what's going to happen. I think gold will have a bid. I think other safe havens may have a bid, but I'm a bit questionable whether we're going to have the same ramp up that we did in the 70s.
Sorry. I would just add one thing. What we are seeing, talking about this uncertainty, and there's obviously a lot of uncertainty. What we are seeing is interesting amongst one particular group of investors, if you wish, which is emerging market central banks. They see all this uncertainty and chaos taking place. They see US dollar interest rates going higher and US debt going up. And what they're reacting to, the way they're reacting to it is actually buying gold. Maybe not in terms of investing 100% of their incremental reserves, but you're talking about increased allocation towards gold, just because they're not comfortable with what's going on in the overall macro environment. And I think that's an important change in behavior, because these banks are very, very conservative in the past, but they're becoming more confident in investing in gold.
I want to go back to the debt level because that's right, because the debt level is so high right now. It's exactly why I think there's not too much room for global interest rate to go up. For example, I think for the US interest rate, it is very, very likely it will peak within a year or two. So no matter whether the Fed is going to raise interest rate 3 times, 2 times, or 4 times next year, I think it's possibly entering the final phase of this current interest rate cycle. And when the time that the US interest rate peaked, that means the dollar will only have one direction, it's down, and which should benefit to commodity prices.
Yeah, this is interesting because the Fed disseminates this talk about the strong US economy and all this, and that they have to raise rates. The real reason why they are raising rates is simply because they need to build firepower for the next recession, which will come. And right now, if the next global crisis hits, there's hardly any firepower left in the central banks to lower interest rates again. They're already negative in Europe. So that's the only reason, and I agree, they will raise a few more times to save their face, and then they'll have to turn around or just sit tight and wait for the next events to happen. And that's
if I can,
next year.
I will disagree a little bit, because I think they may want whatever, but ultimately it's the market that has to decide. And when the US has to finance $21 trillion of debt, and then 22 and 23, then they'll have a problem. And so I don't think it's up to the Fed to really decide. It's at some point it's going to go out of their hands. They have to continue to pull back quantitative easing. So then it'll be the market which will be holding the debt, and then they'll decide what the interest rates are.
Yeah, I completely agree with Sunil. Sorry to interrupt you, but so my job is to be a professional risk taker, and I've been doing proprietary trading for 10 years at a hedge fund and my own hedge fund, and I have to sometimes separate my own emotions and also the fundamentals from just what the market tells me, whether I'm right or wrong. And I think the market is just going to decide on its own. What worries me a lot about gold, even though I want it to go up, is that I can't seem to find a single gold bear anywhere I go. At all these conferences that I've gone to, investors I met, the online community, nobody seems to be a bear on gold. And as soon as gold goes up 10%, then the Twitter feeds are filled up, everybody's getting excited, and that kind of worries me, because that's very, very different from what I remember very early in my career when nobody seemed to have an interest on gold. So I'm not claiming to have an answer. I don't know what's going to happen, but I don't think that we have a really desperate situation in gold, which would make a screaming buy opportunity.
That's an interesting point, but I think this argument doesn't work for conferences like this, because obviously people who come to this conference are by definition bullish on gold. If you go to a cannabis, if you go to a marijuana conference, then you're bullish on marijuana. Right?
Well, let's test it. Given what the panelists have been saying, if we were to come back this time next year, hands up if you think the gold price will have gone down. Hands up if you think the gold price will have gone up. There we go. Fantastic. Well, we'll leave it there. Well, let's move on now to talk about the mining companies and the mining equities. Given your sort of bullish sentiment, what do you think? How are the mining companies performing, and what do you think the outlook is? Samson, do you want to start us off on that one?
I think the current market is quite bad, honestly, and however, it's not as bad as during the period maybe 2013 to 2015. Many equities, especially the juniors, I think their stock price dropped back to maybe 2016 levels. But there is one positive thing that I found is the market still reward discovery. There have been quite a few names this year that made some exciting discoveries. For example, Great Bear Resources, RNX, or RNC, GT Gold, and then both of these shares like shot up maybe 10 times from their bottom levels. I think this is a very good sign because that means at least the market's still keeping a close tab to the discoveries or to the commodity side. Back in the dark periods between like maybe 2012 and 2015, investors would take any opportunity, especially good news, to get out of position. But right now, if some companies still have some like good, interesting discovery, the market will still bid the shares up. So I think it's a positive, and personally, I will keep a close tab on the Philadelphia Precious Metals Equities Index, XAU, to have a short-term forecast on the direction of the gold price, because I think the direction of precious metals equities will have a leading indicator, somewhat leading indicator of how the metal prices will go.
Fantastic. Thomas, what is your take?
I found there was a very interesting event last week when the stock markets had a very bad day. And we can talk about the long-term outlook for gold all year long, and I have long given up trying to predict the timing of when this happens. So this is always a problem. And but what encourages me short-term, there was, apart from the bad sentiment, which was by some indicators as bad as it was in 1999 or 2000 in the gold sector. Apart from the sentiment, there was also the fear among a lot of people that what happens if the stock markets finally roll over? You could have something like in 2008 where the gold market goes down with it because people need liquidity, and so everything will go down initially. But last week when the stock markets went down, gold actually popped up on high volume. Even the GLD ETF had a very strong day on enormous volume. The GDXJ indices went up, and technically they broke through short-term resistances. So if this is any indicator, it tells me that this time, when the stock markets continue to go down, it will support gold, and the gold market will fulfill its role of being either a safe haven, or people will realize, oh, wait a second, there's one asset class which has been overlooked for the last 5, 6, 7 years, and is not as inflated as everything else. And that's very encouraging and very different from 2008.
Absolutely. I think when the ASX fell as well, the top performing companies, mining companies, who went up. So sort of positive outlook on for the mining equities as well. How are the mining companies performing at the moment in terms of cost controls? Are they still being disciplined, or is it time to now say, okay, we need to start building new things and maybe releasing the purse strings a little bit?
I think generally the market has forced companies to clean up their act generally, although you would have expected that a lot of these small companies would have disappeared in the last recession, and they're still around, a lot of these so-called zombie companies. But generally I think it has improved a lot, but I have no doubts that companies and management teams will find ways to spend money again when it's available. So I think nothing will ever change. And John Paulson started this Gold Council initiative, which sounds good. I think it's well intended. But like Jeffrey Christian said recently in an interview, the problem he had with this is when you have, sorry Dan, don't take it personal, but when
I don't take anything personally.
When you have financial investors from New York telling management teams how to run their operations,
bad guys.
That's usually not a good thing.
Absolutely. I think there were some questions raised as well about the compliance issues around that as well, with some funds not able to take part because they shouldn't be following someone else's lead on these things. They should all be doing their own individual sort of due diligence and all that sort of thing.
Well, a lot of things around the gold industry, I've been trying to dig around for the past few years, trying to get answers about how the price of gold is set on the LBMA, and it's an extremely opaque organization. Everything is traded OTC. It seems like most of the gold that is traded is unallocated, and sometimes it's a fraction. Maybe it's a fractionally based system. It's not proven. Although the LBMA has come out with a memorandum of understanding saying that they admit it is unallocated. So that organization kind of piles some questions up. I don't want to get into conspiracy theory because I don't want to believe in anything unless I actually see the facts. But that on top of the fact that most of these gold vehicles, like even the Spider Gold or the iShares Gold, if you read the mandates, it's a promise on the return of gold, not owning the gold. So you're just owning a unit of a trust. So yes, I do think that they have the gold because these organizations are too big to, they have too many other ETFs that they're not going to ruin their reputation based on one ETF. So though I do think that they do have the gold, but I think it makes sense just to have a diversified portfolio. Try not to be too smart. Try not to predict when gold is going to go up, when it's going to go down, whether silver is going to outperform, whether it's platinum, palladium, rhodium, ruthenium, whatever it is. Own all of them. Own a little bit of each. Own a little bit ETFs. If you know how to play futures, play a little bit. And also own physical gold. Most of the storage costs for owning physical gold now, it's extremely cheap. It's probably just as cheap as owning an ETF. So it makes sense to also have some physical gold, and I'd rather keep it at a storage company instead of underneath my bed where somebody could rob me at any day.
So let me say two things. Firstly, I agree with you on the second part. Just to let people know, the actual storage cost, if you actually could do a deal with a storage company, would be lesser than an ETF. It would be roughly about 0.1% per annum. Compared to an ETF of 0.4%, and even now the World Gold Council has actually got a new ETF which is at 0.25%. So the storage costs are quite low, and I agree with the fact that you need to be diversified and invest in precious metals as a part of our overall portfolio. But one thing I would say is, being an insider in terms of the bullion industry, a lot of the conspiracy theories are all that. Everything has an explanation. People just need to sit down and understand it. But it's easier to go out and say things. Just to clarify a few things for you. One is both JLD, IAU have physical holdings of gold. They're audited every quarter by a Big Four audit firm and confirmed. They check each and every bar. They go physically and check the bars and bar lists. So that's one thing. Secondly, as far as the LBMA OTC price is concerned, a lot of people don't know this. It's it's an auction process. Anybody can buy or sell at that auction price. Any of you. So if you think there's a possibility of any fixing, go out and buy or sell whatever you believe, and your price will get reflected in the auction price. It's a fully transparent auction. So a lot of these things are, sound very nice, but are not rooted in fact.
Of course you would say that. Just joking. Do we have any questions from the audience at this stage? I'm sure you've got some, or comments, views. You
mentioned that the Asian central banks been buying gold, right? Can you elaborate a little bit on that?
So traditionally, the Asian banks, when they run up surpluses in terms of reserves, FX reserves, their first point of sort of investment would be U.S. Treasuries, right? And then they would buy euros and yen, and traditionally they've not really got into gold because they were looking at, the portfolio manager in a central bank would say, I'm not sure whether the gold price is going up or down. And over the last 10 years, 15 years, I've personally seen a change in mindset. Maybe there's a new set of portfolio managers who've come on board, and their view is, look, I don't care about the gold price, just like I don't care about the yen-dollar exchange rate or the euro-dollar exchange rate. I need to have 5% of my holdings in gold at whatever price. So they seem to now have put in place plans, purchase like long-term investment plans, saying, okay, every quarter we will buy this much, and they may have some kind of levels, but they would have an investment plan. And so you're seeing them much more regularly in the market, building up reserves, not in big quantities. They may be 30,000 tons, 30,000 ounces, 50,000 ounces a quarter, but it adds up. If you've got 6 or 7, 8 banks in the market, that all adds up into the market.
Samson, I've got a question which you might be able to answer. Recently, Randgold and Barrick merged. One of the speakers at our New York event to describe that as the best and the worst coming together. He didn't specify which was which, but I think we know. What's your take on that merger? What does that mean for the market?
First of all, my first reaction is I'm glad that I'm not a shareholder of Randgold. Otherwise, I would be pissed because the merger is no premium. So I think it's kind of unfair to Randgold if I'm a shareholder. But I think it's kind of showing improvement for the whole sector. I think the whole sector actually need positive news, whether it's emerging news or discovery news, to get the interest back to the market. And frankly speaking, I think there are quite a bit of middle size gold producers have been putting themselves out in the market for sale secretly, because last week I was on a business trip to Beijing, and I present to our Chinese gold mining company about the Canadian mining industry. And the Chinese, they have been actively looking for projects worldwide, but they have some kind of specific criteria. And I can say that what they are looking for, I would say that their mindset is somewhat different from us. For example, they won't put margin as the number one priority. They would focus more on whether it's a producing asset and the resource size. And the third is whether they could finance the project. So probably they would put margin as the number 4 option to consider. So it means the good news is there is some active buyers in the market, but the bad news is right now the whole mining industry is still in very bad shape, and some people are still putting up themselves for sale. So maybe we will expect more merger acquisition in the next 12 months.
What sort of size projects were they looking for?
It's hard because I know they were looking for a project. It is a mega-sized project. I can't say too much because obviously everyone knows which project I'm talking about, but the grade is very low, and the capex is like over $1 billion. So because of the capex, that Chinese mining company lost interest. But I know that if the capex is more financeable, it's more reasonable, then probably they may have some interest to buy out the project.
Speaker. Yeah. Question.
I'm sure everyone in this audience believes that gold's undervalued. So what would be each person's view of what the real value of gold is at the moment? My view, by the way, is $1,375.
Your view on the value, the current value of gold?
Current value is very difficult to say, but where I think 1375 is a good breakout point. We almost got there, and this is what frustrated the market. It bounced against it and then bounced back again. So I think it's a good start, 1360, 1380. Once it finally goes through that resistance, then I think it can quickly go towards 1500, and then we'll see. But I don't really have particular targets for the gold price, but I think it should go down. It should go up, and then we'll see how far and how much.
I don't have any idea like what is the fair price for gold, but despite how bad gold has been performing this year, I have to remind all of you that gold actually has been performing quite well relatively to other commodities. For example, silver, platinum, copper, zinc. So actually gold has been performing somewhat like a safe haven asset already, even before the US stock market tanked a few weeks ago. So I think gold has been doing what it is supposed to be doing, and I think right now there's a short covering rally or some kind of safe haven demand. So in theory, I think gold price, like the current momentum in gold price, should be carried through maybe the end of November or early December, just before the market's attention turn back to the Fed interest rate decision in December. And then next year, I'm not too sure about next year because, as I mentioned before, I think the Fed rates will probably peak in a year or two. So if the rate peaks sometime at the second half of next year, so maybe, just maybe, the gold price may also bottom at the similar timeline.
If I can, I just give you an idea in terms of the price. I think it's fairly priced. I'll give you an idea. Since the beginning of the year, the gold price has declined by 6.5% in US dollar terms. However, it's gone up 8.7% in South African rand terms. It's gone up 5.4% in Indonesian rupiah terms. It's gone up 3.5% in Aussie dollar terms. It's up about 1% in Canadian dollar terms. And it's basically flat in renminbi. So it's not done badly. So I would say that just looking at it in US dollar terms, it's not that accurate as a position. I think really going forward, there's so many variables. It's going to be difficult to say, but it looks like you'll continue to see it edge upwards towards the $1,300 levels.
I think it's kind of a trick question because the market is always right. So it is currently fairly priced, in my opinion, because the market is the market. But having studied commodity cycles, I think you said in a panel yesterday, Leo, that, or maybe it was somebody else, the history doesn't repeat, but it does rhyme sometimes. And commodity cycles do come and go. If you look at the last 300 years, maybe the average of the medium cycle is around 50 years or so. Maybe the mini cycles are around 20 to 30. So, if we say that the last peak was around somewhere between 2008 to 2011, you add 30 years to that, or maybe 20 years to that even, and we're still looking at the 2030s before we see a big peak. So maybe the audience will not like this question, but my plan is to keep holding until then, because we're eventually going to have a peak again. And if I had to put a price on it, if you look at the price of gold divided by the U.S. monetary base, which is all public information, it's at a historical low right now. And if you take the average of that over, I think the data goes back to like the early 1900s, before there was even a central bank. So I don't know if it's even really reliable to look at that data. But if you look at the average, you're starting to look at bigger numbers, between $5,000 to $10,000 an ounce. So just to be conservative, as I'm always conservative, maybe I would take that somewhere in that price range divided by 2, given that we have a lot of debt in the world, and debt is deflationary. Nobody can fight this. No government, nobody in the world can fight debt. So yeah, maybe $3,000, and 10 or 20 years. That would be my guess.
Question for Marcus.
In every business school education and the practitioner, they teach you the single most important parameter in running a business is unit cost. In the last few years, particularly the big miners, they have had $1 billion of cost reductions, therefore massively reducing their unit costs. Therefore, a bit a critical question, is there actually still an economic justification for junior miners in high-cost locations like Canada, Australia, where drivers make, $150,000 northwards? I mean, is there an economic justification for, junior mines in these countries? Because rationally speaking, I simply don't see, particularly with interest rates going up and credit spreads and risk spread going up, that they ever will be returning, money, unless they're really as lucky as, a guy who is betting on the right horse down in Chatin.
Well, I think there's an important point, right, in terms of demand versus supply. Demand for gold is still outstrips supply in terms of mine supply. So you have a situation where demand is anywhere between 3,000 to 3,500 tons a year, and mine production is anywhere between 2,400, 2,300 to 2,500 tons. So that would mean that as long as it's economically profitable, even for $1, people are going to produce. Right? So I think that will carry on. Just one point I would like to just leave out there. I know it's something that amongst the mining community, it's considered to be anathema. You don't talk about it, but that's the subject of hedging. I think one thing people need to keep in mind is as the interest rates move up, okay, you have a situation where if the gold price moves towards the $1,250, $1,300, people are going to start looking at the fact that if I sell 5 years forward, I may actually yield $1,400, $1,500. And if my costs have gone down to $800, $900, let me just lock in the beautiful cash flow I have and run with that. And the management can be safe and the shareholders get paid in terms of dividends. So that change in mindset hasn't set in yet because you still have those people who think about blue sky. But remember, the CEOs in these companies and the big majors are changing. They're all younger MBAs, and they're looking at cash flows. So I think you will start seeing that change in behavior probably next year when the interest rates start creeping up to that 3.5%, 4% level for 5 years, 7 years forward.
That would actually be great if the new Barrick Randgold implements a massive hedge program again, because that would definitely be the bottom of the market.
Willem.
Yeah, I feel the need to react to Daniel's remark that markets are always right. And for somebody who has witnessed the great financial crisis from the inner circle, as you explained, how can you say that markets are always right when Lehman Brothers declined by 99% within a week?
Well, markets are always right at that moment, and they change every single day. That's the beauty of the markets, right? So that this is just my opinion.
You spent too much time on Wall Street, sorry.
Right. Well, in my experience, nobody knows. I guess that's what I was trying to say, is that nobody knows. Everybody can have a great prediction based on fundamental, technical, whatever. But today, the price of gold is a little over $1,200, and it is what it is. And we don't know. And nobody knew during the GFC, and I don't think anybody knows right now, in my opinion, because...
I think we know, because there's a great graph and which shows the correlation between the gold price and the amount of money in circulation. And I think it was Mike Maloney who produced this graph, and it goes back 150 years. And you can see that the gold price always returns back to the line in the graph of the broad base of money, the M2. And if we take that graph as an example, gold has to be revalued north of $10,000 an ounce. And this correlation has been ongoing for a few hundred years. So I'm of the opinion that markets are always wrong. So that's what gives undervaluation and overvaluation. So
well, markets can be irrational a lot longer than any of us can stay solvent. And that was another big lesson I learned during the GFC, is that they can stay irrational for a long time. We could all be dead by the time gold is at $5,000. And I know we don't want to hear this, but you look at Japan. So I studied Japan in college, and I'm half Japanese. I was born there. I was raised there. If you look at Japan and their debt and why the treasury yields are so low, it doesn't make any sense, right? They're spending, 25% of their GDP every year, or their treasury reserves every year, just paying their interest payments. It doesn't make any sense, but it's still happening, and it's still declining, and it's still going. So I guess that was my point to say is that, yes, markets can be wrong longer term, but on a day-to-day basis, the market is the market. It's a group of buyers and a group of sellers meeting to exchange at a certain price. But yes, I agree, longer term, they can be completely wrong. But we don't know because the market, in my experience, is a very emotional machine, and it will do whatever it wants, even if it's irrational, and no matter how long it goes for.
I actually kind of agree Daniel's say like nobody knows, because for example, like back in June, if Donald Trump tells me he's going to start a global trade war with China a week earlier, and then I'm going to lose my shirt if I start a long position in the gold futures market. So like under normal circumstances, like if you know there is some kind of uncertainty increase of geopolitical risk, normal traditional thinking will, I have to long gold, I have to buy gold. But this time, I mean, because of the global trade war, the gold price, like they still fell. Like they fell less than other metals, but they still fell. So like, if I participate the futures market, I will probably lose my shirt by longing gold. So I kind of agree with Daniel. Like nobody knows what happens, even if gold price is going up in the long run. But sometimes if you take too much leverage and make a short-term bet, and then you can go bankrupt easily. So I think...
mind you, just to be clear, I am very long precious metals, so I hope it does go up. I really do. My experience has taught me that I have to separate whatever I want from whatever the market does. So I own silver, I own precious metals, I own gold futures, I own gold ETFs, and I agree with the fundamentals. But there's $10 trillion in negative interest yielding bonds right now, and this doesn't make sense. It's never happened in history. And the only rationale I could see is that because the pension funds around the world have a humongous liability that's, I think, close to 100 trillion, they have to buy bonds. They don't have a choice. It's in their mandate, right? They have assets and they have liabilities. Right now, their liabilities are outweighed by their assets, so they have to keep buying assets. So I feel like money is going towards these assets that are producing very low yield, and now the market is desperate for yield. So when the market's desperate for yield, it's not going to go for commodities, right? Because commodities, by nature, they don't yield. So I'm cautiously optimistic, I guess, is maybe the best way to summarize.
Absolutely. We're kind of running out of time now. So do we have one more question from anybody out there? We've had some very good questions so far. Oh, Marcus has another. Go for it.
Just a remark I read on Germany's largest newspaper to remind you all. You talk about debt. What did the Frankfurter Allgemeine write on the Sunday issue about Italy's debt problem? It wrote, why doesn't the government just take it from the households? Okay? So don't forget, the government can tax you 100%. Okay?
There we go. That's it.
10% inheritance tax, okay? So that's how they're going to solve the debt problem. Inflation or tax it out of your pocket. The Frankfurter Allgemeine wrote it on Sunday. If you don't believe it, go to their front page.
Fair enough. It's pretty scary. So you better buy some gold or buy some gold mining stocks or something. Let's finish this up though with your view on the year ahead for gold and equities. How should we? What's going to be the best performing way? What's going to be the best way to play the market in the year ahead? Is it going to be bullion? Is it going to be gold mining stocks? Is it going to be? What's it going to be?
So in 2018, this year, 83% of IPOs in the US were companies that are losing money. In history, the only other time it's been close to this was the year 2000. So I think kind of that fact says enough that we are in a very bullish market. 60% of the Russell 2000 companies have interest that their net income is not enough to cover all their interest expenses every year. So we're in a very highly positive, highly sentiment environment. So I would think that the stock market is going to correct. I think we're due for a 20% correction. It's just natural. It happens. It's just like catching a cold. And if that happens, then gold price will go up short term over the next year.
Just given where I am, I have to say buy mining stock.
There you go.
Asset allocation. But I will probably go for more cash and waiting for a real market bottom sometime next year.
What point sometime next year?
Second half, maybe third quarter.
Thomas?
Yeah, although I try and avoid predicting timing, but I think we are coming close to almost a perfect storm. So I think 2019 will be the beginning of a few years of major shifts where you see all this money that's been created through quant easing and central bank printing over the years, which Dan correctly said hasn't created the inflation that everyone was expecting and was the reason for some of the disappointment in the gold market. But now you see slowly this money is finally coming out of the banks where it's been parked into the economy. And at the same time, all these asset bubbles, stock market, bonds, art, all these other bubbles are beginning to deflate. So I think we're now beginning to see gold and with it the junior markets going up. And I think this will be happening and starting from next year, 2019, over the next 3-4 years and probably peak around 2022, 23.
Fantastic. Well, sounds like you've called the bottom there. Excellent. Well, we'll see. We'll come back next year and see how we're getting on with that. But can I have a big round of applause for our final gold panel then?